Well, it was the largest one-day increase in 22 years. The last person to raise interest rates 50 basis points was Alan Greenspan, which was famous for saying irrational exuberance. But today's plan was very much in line with what the street projected, the 0.5%. And then there's potentially more down the road, like as you alluded to, 50 basis points and maybe 2 or 3 meetings. We don't know how aggressive they'll be. We're looking at the minutes to see if there was any telltale signs of like how aggressive they'll be in the next meetings. But the problem with monetary policy, unfortunately, is it can't equate for a COVID or pandemic and the Ukraine war. So monetary policy can only do so much to combat inflation, which is at a 40-year high right now.
And the White House, in the meantime, is saying that they do expect these rate hikes will result in a soft landing. A soft landing. What do they mean by that exactly, and what can consumers expect in the meantime?
So the Fed's mandate, the Fed, it's not a political entity by any means for reviewers. I mean, the Fed's mandate is to try to control inflation. And what they try to organize or architect is to have what is called the soft landing, where they're not pushing us into a recession. So if the Fed was too aggressive or they miscalculated, they run the chance of moving the economy into a recession, which would be a bad thing.
Yeah, and you keep using that R word. So even though this may help bring inflation down, could this ultimately lead to a recession? Because I know a lot of economists are pointing to that at this point.
Yeah, the true answer is we don't know. I mean, it's going to depend on how it's received. Again, if it's too aggressive and then the economy's slowing down, I mean, if it was at a peak last month and they continue to push interest rates, then that could push us into a recession. And it's also important to mention that this is not just a U.S. issue. All the central banks across the globe are doing the same thing. UK has already increased their interest rates 3 times so far. They have about a 7% inflation. We're about 8% right now. But that's the delicate balance right now, is like how much, how quick, and how much is really going to be effective.
Right. So you're saying that we're at about 8% inflation right now, and this is not the double-digit inflation that we saw in the 70s. But I think that at times like this, it's good to look back at the Fed's track record. How many times has the Fed successfully fixed a problem like this?
I'm not really sure, to be candid. I mean, there's been obviously a lot of comparisons with the 70s where we had double-digit rates of returns. And then obviously in the 80s and then the 90s when Greenspan pushed interest rates to that 5% and was trying to take the asset bubbles out. But it's a very delicate balance and not very accurate type of thing to predict by any means.
So in your opinion, how concerned should Americans be at this point? And is there anything else that the Fed or the government can do to make things better?
Well, for your viewers, the economy works on cycles. So, we've gone through this before in multiple different variations. History, it does repeat itself in a lot of ways. What's different again is COVID and Ukraine. Those are different wrinkles that we haven't had to deal with. But I think for your viewers, if they have variable interest rates and credit cards, that would be the first order to try to get those balances either paid off or paid down, because within 1 or 2 billing cycles, you're going to start to see that impact of those increases appear in those bills. So you want to try to attack anything that's tied to a flexible interest rate right away.
All right, so you're saying make sure you monitor your credit cards in this situation. Also, for all those folks at home that are looking at their 401ks, obviously the markets have been impacted by this. What should they be doing right now?
Well, I mean, it's really important to go do a deep dive on the portfolio. There are areas of the economy that are doing quite well that are interest rate sensitive, like commodities, healthcare, things that have been going up a lot. So you want to look at the portfolio to try to figure out what can benefit ultimately from rising interest rates. And there's things like Treasury and protected bonds that, for example, that might be appropriate. And then I want to advocate that you probably look at your bond allocation and where you are on the yields curve, because as interest rates go up, the bond portion might start to go down. So it's really worthwhile to do a deep dive, look at the overall allocation to make sure it matches up with your time horizons.
All right, and finally, the last time the Fed met, they raised rates 25 basis points. Today we saw 50 basis points. So how long can we expect the Fed to raise interest rates here? And is there any guess as to when we see them come back down again?
We don't know. I mean, the surveys on the street are for 3 more times, maybe 50 basis points each time. They said in their minutes today that they could be quicker. or slower. It really just depends on the data that's coming out for inflation. I mean, has it peaked? We don't know. But things have been escalating pretty dramatically. So it could be faster, it could be slower. We just don't know.
All right, Mark Scribner from Oxygen Financial. Mark, thank you so much for your insight on this. We appreciate it.